Hi guys, it's Chad Larson with MLD Wealth Management. Continuing along this endeavor under some of the new circumstances, I'm trying to make sure we're developing some content and keeping our clients informed with some of the assets that have exposure to within our portfolios. And I'm here today joined by Varun and Anand, portfolio manager with Starlight Capital, who manages the Starlight Global Infrastructure Fund for us. And I wanted to first, thank you for being here, but Varun, I'll pass it over to you to at least introduce yourself to our clients and who you are and some of your background before we get going.
Sure. Thanks, Chad. And it's a pleasure to join you today remotely. So as you mentioned, I'm the portfolio manager on the Global Infrastructure Fund at Starlight Capital. We launched in October 2018, so we're just about coming up on 1.5 years in terms of the tenure of the fund. Prior to Starlight Capital, I was at CI Investments, and prior to that, I was at Sentry. So Sentry is really where I began my kind of infrastructure investment career. Worked on the Sentry Global Infrastructure Fund there. At the peak, we hit about 800 million in AUM, and then subsequently CI bought Sentry, and they dismantled the team, but they took the infra fund and actually ported it over to CI, and I went over with it. And then the assets under management went to about 5.5 billion because CI has several balanced funds with infrastructure. So it's been beneficial to kind of have the whole spectrum in terms of AUM, starting out a small fund at Starlight Capital, and then also being the largest infrastructure buyer in Canada at CI. Since launching at Starlight, it's been a good 1.5 years, despite what's happened obviously over the last couple of months. It's been a good way to demonstrate the value of infrastructure in client portfolios. And that's obviously the topic du jour today. So I'm excited to kind of discuss some of the things that we're seeing in the market, as well as what we're doing to differentiate our offering from other competitors in the market and really showcase why infrastructure is a really important part of the client portfolios today.
Sure. I think with that, thanks, Varun. I think we've definitely set ourselves apart in the Canadian wealth management landscape and such, made real assets and infrastructure a meaningful way within client portfolios for a myriad of reasons, which we have discussed before, to mirror more like that of a large pension or endowment. I think maybe very quickly in brevity, explain to our clients that may or not familiar, what are infrastructure assets, what entails inside of that?
Sure. So at its very basic definition, infrastructure assets are assets that provide essential daily services in a supply-constrained manner to the majority of the population. And typically that kind of breaks you down into 3 buckets. You have your energy, industrials, and utilities. And those are the things that all of us are familiar with, whether it's airports or pipelines or utilities, kind of day-to-day things that we all see and touch and understand. But at Starlight Capital, what we've done is that we made the decision to broaden the definition of infrastructure. And what we've done is that we've included what we call infratech, so infrastructure technology companies. And the reason why we've done that is because in today's economy, where it's becoming more and more digitalized, I mean, right now with what's happening with COVID, digitalization is kind of dominating everybody's day-to-day life, whether you're on your phone or you're on Zoom or doing remote access for your servers in a data center. This is something that has now, before was optional, but now is essential in every day, whether it's a corporate thing or even a personal thing. So that's why we broadened the definition, and we still have to meet the same criteria. So it still has to provide an essential daily service, high barriers to entry, limited competition, and most importantly, must be a very strong free cash flow generator. And that leads us to invest in companies like data centers, cellular towers, payment processing. And these are the types of companies that I think, within 3 to 4 to 5 years, a lot of our competitors are also going to include them in their benchmarks, simply because they are going to become such a dominant force in terms of not only our daily lives, but in terms of the markets as well. So that's why we've decided to broaden it and start today, because we'd rather be ahead of the game than be late. And I'll allude to it a little bit later on when we're speaking, but it'll kind of demonstrate how these stocks have performed this year and show why they're becoming such an important part of the economy.
Sure. Varun, you and I have had the benefit of talking quite often, and obviously the cadence to our contact has been increased through this COVID crisis. I don't think I really want to necessarily get into, one of the questions we discussed is how COVID is affecting infrastructure companies today. Not so much from a market pricing perspective, because we have seen a disjointing in pricing as there's a race for liquidity and panic ensues. I think more to understand that not all infrastructure, I think people very quickly, they gravitate, and I have conversations all day long with clients, and they say, airports are in trouble and this is in trouble. And, what are some of the, call it, subsectors within that GICS of what you would oversee as a universe that maybe, you have avoided significantly and where maybe you see opportunities?
Yeah, no, that's a great question. So let's put aside market prices and valuations, all that. Just think about the actual business, right? So you mentioned airports, and airports is a really good example because historically it's been one of the strongest infrastructure asset classes. The reason for that is airports generally don't have any competition. So in Canada, actually, Canada's not a good example because Air Canada is kind of the only competition for WestJet. But if you look at the US or the UK or multiple European countries, there's multiple carriers that are fighting for the customer's dollar, but they're all flying to one airport, maybe one or two in most major markets. And as a result, these airports are regulated by the government. They have regulation periods that can range anywhere up to 70 to 80 years. They're inflation adjusted, and they're leveraged to economic growth. So historically, airports have actually grown at a multiple of GDP because air travel has actually increased by more than what economic output has. But in the light of what's happened with COVID is that it doesn't matter how strong your asset is, how limited the competition is. If people aren't flying, airports aren't going to be making any money. So in January, when we kind of saw the curve steepening in China and started to see some early results of what was happening in the Chinese market, we decided to actually pull out of all our direct airport plays because the thought was, it's not like they were cheap at the time. So should COVID not become an issue, then, that's fine. We take our profits and we deploy it elsewhere. But if COVID became an issue, which subsequently it did, a lot of these airports are going to see traffic decline dramatically. Now, I never predicted that Eurozone traffic would decline 90% or US traffic would decline 90%. I thought it would probably be in the 50 to 70% range. And basically what's happened now is that you have airports that are empty, airlines that are on the brink of bankruptcy, and this is going to be a very slow recovery. So when people say, V-shaped recovery, I think there's certain sectors that will actually have that. But with airports, the thing to remember is that, number one, you have a very fragile customer in airlines. These guys are fighting for as much government bailout money as they can get because they're overly levered, and it's a high fixed cost business, right? So you can't just run it without any cash flows coming in. But secondly is that the difference between COVID and, let's say, SARS or Ebola or MERS or any of the other pandemics we had is that this is the age of social media. And with social media feeding you stuff about Corona every single day, then you turn on the TV, then you go to the CNBC, I think the psychological impact on people in terms of travel and going to other countries is going to be much more severe this time around. And as a result, you're going to see the curve be very, very flat. Like maybe you'll have a U-shaped or even in a worst case, an L-shaped recovery until we have a vaccine, until we have more progress. And that's where we think airports are not a place to be. We do make exceptions for that. And the reason for that is that everything has a price. So when we're looking at airports today, some in New Zealand and Sydney actually look priced quite reasonably because they're down 50, 60, 70% in some cases. So that's where we have to really put on our analytical lens and say, okay, you know what, how much is factored in? Do they have the balance sheet to withstand a year and a half of below average traffic? And how will they emerge coming out of this? So we haven't pulled the trigger as yet, but that's something that we're very, very keen on adding to because these airports don't regularly get cheap. And you can see the chart on them kind of before Corona have been very strong generators of return for shareholders. So that's what I would say is, go ahead.
Okay, that's great. One of the things, like as we've had numerous discussions, even intraday throughout trading, what type of strategies have you been able to employ in and around some of the, day to day we can look like heroes and zeros all in the same day? Is there a portion of the fund that you've been successful and seen positive attribution from being tactical and being able to make those decisions under your mandate?
Definitely. So, I mean, one thing to keep in mind is that how we invest, it's very long-term. We're not day traders by nature, but when the market presents you with this kind of volatility, you have to take advantage, right? So what we've been doing a lot is actually writing options. So we've been writing puts and writing calls, and that's really just a way of keeping yourself disciplined. Because, for example, if American Tower hits $300 and I wrote a call on it and I got called away on it, I'm happy with that because that means the stock's ripped 40 to 50%. We've done a great job for our shareholders. We'll take that money and redeploy it. But in the case that it doesn't reach that target, I've collected a very hefty premium for because of volatilities in the market. And then it's the same thing on the put side where we've sold a lot of puts saying that, if stocks do get down to these bargain levels, we're happy to buy them. And if they don't get there, then we collect the premium. So that's one way we've really been trying to capture day-to-day volatility and generate kind of these incremental returns. The second thing I would say is that when we see drastic moves in the market, and I'm talking about more like the last half of March where we had up 7%, down 5%, repeatedly, that's where we took advantage. And it was really when it came down to companies that didn't deserve to be punished the way they were, that's when we were buying a lot of them. So renewable energy companies, for example, there was a day where Boralex was off 17%. Now, this is a renewable energy company that has wind farms in France and hydro in Canada and some solar farms that they're going to have in New York. That doesn't make any sense. And when I dug into it, because I talked to some traders and I said, what's going on? This doesn't make any sense. And they said, one is it's a mid cap, so it's kind of in that range of between 5 to 10 billion that people target because it's perceived as illiquid. And then secondly, it's because it has high leverage. Anything over 4 times net debt to EBITDA, just got to sell it. It's too dangerous. But if you do your homework, you realize that with renewable energy companies, majority of the debt is project level non-recourse debt. And what that means is that when Boralex builds a wind farm in France, the creditors that loan them the money against that farm can only go after the cash flows of that wind farm. So they can't go after the parent company. They can't go after any of the other assets that Boralex has. So while the debt appears really high, it's actually very low risk debt because it's tied to each individual asset. And keep in mind is that the reason why they get such favorable debt terms is because renewable energy is pretty stable. It's very low risk. Your biggest input to a wind farm is the wind, which is free. Biggest input into a solar farm is the sun, which is free. So it's these types of things that make creditors comfortable because the likelihood of a solar or wind farm from an experienced developer going belly up is very, very small. And that's why they get not only low interest rates, but they get project level non-recourse debt. So what we've seen is that on days like that, we're happy to buy, take the other side of the trade. And now that we've come into this, I don't even know what to call the last 1 or 2 weeks, but it seems like things have settled down a bit and people have done more homework. And now names that aren't as impacted from Corona are actually not getting killed on the days the market's down. And Boralex, for example, went down to, I think it was $17.50 and it's back to $27 in 2 weeks. So that's just one example of how we've tried to take advantage of volatility on a day-to-day basis because we've done our homework. We know the companies that can deal with the leverage, can deal with, the shakeout of COVID, and we're happy to take those trades.
Great. Varun, probably just in keeping things brief, and I'd like to have you back potentially on a monthly basis because this sector is one, especially when I look at the in general investing landscape of retail clients, we tend very quickly to host geographic biases and things that we know and things that we understand, and how much of the from a just very rudimentary points, I don't hold you to complete accuracies, but would you look at the globalization or the exposure in the portfolio? How much of it would be internationally focused, and where would you see the more dominant? Obviously, the U.S. making up the largest economy in the world and largely the largest investment landscape by far. Where would you see a lot of the assets and investable geographies that the fund would have exposure to?
Yeah, so I mean, if you had asked me this question 6 months ago, I would have said I would have had a much more broad answer. But because of what's happened with COVID and then the impending economic impact, we've decided to really high grade to developed markets. And within developed markets, we've decided to high grade to North America. And there's a few reasons for that. But when you look at Europe, for example, is that was a continent really that was pretty weak going into Corona. So they had robust growth, they didn't have robust GDP, PMIs, et cetera. And now you lay on a pandemic and economies that have been frozen and a central bank that's already stretched. And keep in mind, they already had their debt crisis last decade, right? That's where we get a little bit scared of really going in deep into Europe now because not only did Italy and Spain and the UK get impacted by COVID on its own, but I think the recovery is going to be much slower there. The snapback is not going to be as fast as North America, simply because we were in a better position of strength going into this. That being said, in the US and in Canada, I think there's still going to be some pain to be felt in some sectors, and there's going to be some strength in other sectors. So when I talk about infratech, that's dominated by the US. The absolute best tower companies, the best data center companies are all in the US. And when I look at the portfolio today, every single one of our towers and data centers are positive on the year. They're positive in anywhere from the range of 12% to 28%. And that really speaks to not only the quality of the companies, but the scarcity value of these types of companies in this market. You go to Europe, and the only pure play European data center that was available was called Interaction, the company that we had a very high weight in, and it was taken out by Digital Realty about 6 months ago. So you don't really have many opportunities in Europe. In Australia, there's one company called NextDC that we actually participated in an institutional offering and have initiated a position in that. But again, coming back to kind of what your focus was, is that we will be very picky with what we do in Europe. We still have European exposure and Australian, but it has to be a very, very compelling valuation, or it has to be a very strong asset class. And right now, our European names, like Ferrovial is probably one of our favorite names in Europe, and about 40% of the value of that name is its stake in the 407, which is a Canadian asset, right? And then they also have US assets in terms of managed lanes. So in terms of pure play European infrastructure, that's not a place where we want to be deploying capital right this minute. But like I said before about airports, is that there is a price for everything, and should they get cheap enough, we have the dry powder and we have the homework done to deploy when we're ready.
Awesome. Varun, I think we'll just keep it there. I really appreciate you taking the time to chat with me. I'm wearing my Friday t-shirt, so hopefully get some comments. But stay safe and enjoy your weekend, and we'll chat soon. Thank you very much for joining us.
Thank you for having me. Take care, Chad.